Welcome to the deep dive. Today, we're really getting into the Nifty IT sector. It's such a key part of the market, and honestly, it's seen some major shifts lately. Our goal here is to unpack what's really driving things, the narrative around Indian IT right now. We'll focus on the data, the observations, what's shaping its future.
Absolutely. And it's crucial we understand these shifts. What's happening in IT, it's much more complex than just, say, a simple market dip. This could really redefine the sector for years, maybe even give us a peek into broader economic changes coming down the line.
Okay, let's unpack this then. I was looking at the numbers, and wow, the Nifty IT index, down over 16% in the last 6 months. But then you look at the Nifty 50, that's up around 7% in the same time frame. I mean, that's a really wide gap, isn't it?
It is. And that divergence, it tells you a lot. It screams growing investor caution. It points to these deeper structural worries that are getting priced in. Things like slower growth, sure, but also more automation, AI, and maybe this decoupling we're seeing between headcount, the number of people they hire, and the revenue they actually bring in. It's like the IT sector isn't that automatic go-to for growth or safety anymore. The game's definitely changed.
Right, that headcount point is fascinating because historically, IT growth meant hiring thousands of people for big contracts. Revenue and headcount went hand in hand. So here's where it gets really interesting. What's actually different now? Why is that link weakening?
Well, the big difference now is definitely automation, AI, and especially these new generative AI tools. They're fundamentally changing how work gets done. Think about it like this. One really skilled employee, right? But now they're boosted by AI tools. They might genuinely do the work that needed 2 people before.
So it's efficiency gains driving it.
Exactly. And we're seeing it in practice. Look at TCS. They announced plans, I think, for FY26 to potentially reduce headcount by around 12,000. And the market didn't panic. Investors mostly saw it as, an efficiency play, getting leaner, more productive, not a sign the business is shrinking.
Interesting framing.
Yeah, because it's not necessarily about less business. It's about optimizing the bench, using AI for productivity boosts, even things like employee preferences, maybe wanting less travel or sticking to certain domains. These kinds of right-sizing cycles, they do happen, maybe every 8 to 10 years. But this time, it feels different. It seems driven by these new nonlinear business models, not just cutting costs the old way.
It's almost like a paradigm shift then. For years, hiring more people was the sign of success.
Precisely. Now, maybe the badge of honor is doing more with the same or even fewer people, a completely different mindset.
Okay, so that headcount shift is huge. But what about the revenue side? You mentioned moving away from just billing for hours. What's emerging there?
That's the other side of the coin. The revenue model is evolving too. Less pure hourly billing, more consulting-led work, also platform or IP-based services where they own the underlying tech. And increasingly, these outcome-based deals.
Outcome-based? What does that look like?
Well, instead of just billing for, say, 1,000 hours of coding, a company might get paid based on the actual business results they deliver for the client, maybe a percentage of cost savings, or a fixed fee for achieving a specific transformation goal. This lets revenue grow without needing to hire proportionally more people. That's that nonlinear scalability we talked about.
And GenAI speeds this up.
Massively. Clients aren't just looking for someone to manage their IT systems anymore. They expect partners to help transform their whole business using these new tools.
But does that introduce new risks, like higher client expectations, maybe scoop creep? Is there a trade-off?
Oh, absolutely. That's a great point. The accountability is higher. You really need deeper partnerships. But the potential reward, a much more scalable, potentially more profitable business model.
Okay, so the business model's changing. Headcount correlation is changing. How are the big institutional investors, like mutual funds, reacting to all this turbulence?
Well, their positioning tells a story. There's a study, I think by Elara Capital, found that something like 60% of major asset managers are actually underweight on IT right now.
60%? Wow. Any specific names?
Yeah, firms like ICICI Prudential, Quant, PPFAS were mentioned. It really points to a kind of consensus caution in that institutional space. They're holding back a bit.
And why is that? What's the rationale behind being underweight?
It boils down to a few things. One is just weak earnings visibility. Most IT firms are guiding for pretty low revenue growth in FY26, maybe only 1 to 3%. That's not exactly exciting. Then there's this trend of companies preferring to give cash back to shareholders through dividends and buybacks rather than reinvesting heavily in growth. And of course, there's still a lot of uncertainty about AI and automation. What's the long-term impact on demand for traditional IT services going to be? So many are taking a wait-and-see approach.
Okay, that makes sense. So with all that caution, let's talk valuations. Are IT stocks actually cheap now after these drops? Or are they still looking expensive? Where do things stand?
Right, the valuation question. It's tricky, and it really depends if you're looking at the large caps or the mid caps. For the big players, think TCS, Infosys, HCL Tech, Wipro. Their forward price to earnings ratios are currently hovering around, PCS is about 21.6x, Infosys 21.5x, HCL 22.3x, Wipro around 20x.
And how does that compare historically?
Well, they're a bit above the pre-COVID norms, which were more like 17 to 19 times earnings, but they are way down from the peaks we saw back in 2021.
So not rock bottom, but not sky high either.
Exactly. And while they do have stable cash flows and offer decent dividend yields, maybe 4 or 5%, which provides some support, that doesn't really offset the narrative of weak growth right now, so they're sort of stuck in the middle.
Okay, what about the mid-caps then? They often have a different story.
They certainly do. Mid-cap IT stocks are still trading at a significant premium. That's generally because they have been delivering higher growth rates. You look at names like Persistent Systems, it's trading at over 42 times forward earnings. Copage is around 37x, LTIMindtree near 28x, Oracle Financial Services about 27x.
Those are pretty punchy multiples.
They really are. And the crucial point here is those premiums are only really justified if they can keep delivering that double-digit growth, which, given the current cautious demand environment we've been talking about, is, well, uncertain. It's a bit of a high-wire act for them. Can they keep it up? That's the big question.
So for mid-caps, it's really about proving they can sustain that high growth even in this tougher climate.
Precisely. It's less about where they are now and more about proving where they're going.
Got it. So tying this all together, how much is the IT sector's performance linked to just the overall global economy? What's the macro picture telling us?
It's heavily linked. Remember, a huge chunk of Indian IT revenue comes from global clients, especially in the US and Europe. So these macroeconomic headwinds we keep hearing about, central bank policies like the Fed's decisions, inflation worries, even trade tensions, they directly impact IT spending, particularly discretionary spending, those nice-to-have projects. Companies tend to pull back on those first when the economic outlook gets cloudy.
So belt tightening globally means less work for Indian IT.
In many cases, yes, or at least delays in starting new projects. Now, there is some hope among fund managers for a potential recovery, maybe in the second half of fiscal 26, but that really hinges on the global macro picture stabilizing first. Until then, you'll likely see most IT companies focusing inward on cost optimization, productivity gains, not really aggressive expansion, more defensive.
Right. So bringing it back to our listener, what's the key takeaway here? It sounds like the Nifty IT's rough patch isn't just a temporary dip. It's more like a deeper structural transformation happening, isn't it? Valuations aren't crazy high anymore, but that growth engine seems muted for now, and there are real headwinds.
That's exactly the picture. This feels like a transition year, maybe even longer for Indian IT. It's a pivotal moment. So for investors, maybe the sector is best viewed, for now, as a potential value play, focusing on that cash flow and the dividends from the large caps, and perhaps being very selective with the mid caps, really focusing on those truly driven by innovation that can maybe buck the trend.
And the bottom line?
The bottom line is, look beyond just the headcount numbers. That's the old story. Now, you need to focus on how well these companies are actually integrating GenAI. How are they evolving their delivery models? Can they protect their profit margins even if revenue growth stays slow? And maybe this prompts a question for you, the listener. How might these same forces, automation and changing business models, be playing out in other industries you follow?
That's a great point. Well, thank you for joining us on this deep dive into the Nifty IT sector. Really fascinating stuff.
My pleasure. And just a final thought. These forces we discussed, automation, AI, shifting client demands, they aren't unique to IT. They're changing how businesses operate everywhere. What we're seeing in IT today could very well be a preview of broader economic shifts that are on the horizon for many sectors. Something to keep in mind.
Absolutely. And just a crucial reminder for everyone listening, please remember we are not SEBI-registered financial advisors. If you're thinking about making any investment decisions based on what you've heard today or anything else, please consult with a certified financial advisor first. Get advice tailored to your own situation. Thanks again for tuning in. Keep exploring and stay curious.